Welcome back, navigators. Today's video we'll see strategies to minimize losses coupled with ideas to identify quality stocks at discounted prices during market downturns. So, imagine this. Sarah, a new investor, poured her savings into the market. She had done her research, read countless articles and felt confident in her decisions. The market seemed like a golden opportunity, a chance to grow her hard-earned money. Everything was booming, her portfolio soaring. Each day she watched her investments grow, feeling a sense of accomplishment and excitement. The green numbers on her screen were a testament to her smart choices. Then headlines screamed, "Crash!" Fear gripped her. The news was everywhere, and it seemed like the world was ending. Sarah's heart sank as she saw the red numbers and the panic in the eyes of other investors. Sarah's gains vanished. She panicked, selling everything. In her fear, she didn't stop to think about the long-term implications. She just wanted to salvage what she could, but in doing so, she locked in her losses. Months later, the market recovered, as they always do after downturns. Sarah missed out, filled with regret. She watched as the stock she had sold rebounded, realizing that her hasty decisions had cost her dearly. This is a common story. Market crashes are scary, but understanding them is key. Many investors, like Sarah, react out of fear rather than knowledge. Education and preparation can make all the difference. Don't be like Sarah. Be prepared, not panicked. Develop a strategy. Understand market cycles and stay informed. Knowledge is your best tool against the fear that market volatility can bring. This story highlights the emotional roller coaster of investing. The highs can be exhilarating, but the lows can be devastating if you're not prepared. Panic leads to bad decisions. When emotions take over, rational thinking often goes out the window. It's crucial to keep a level head and stick to your plan. Knowledge empowers you to navigate volatility. By understanding the market and having a solid strategy, you can make informed decisions even in turbulent times. Remember, market downturns are inevitable. They are a natural part of the economic cycle. Every downturn is followed by a recovery, and those who stay the course often come out ahead. Don't let fear dictate your actions. Stay informed, stay calm, and trust in your strategy. With the right knowledge and preparation, you can weather any market storm. What exactly is a market crash? It's a term that often sends shivers down the spine of investors and financial analysts alike. It's a sudden, sharp drop in stock prices, usually of 20% or more within a single day or a few days. This rapid decline can wipe out significant value from the market. Think of it as a market panic attack, where fear and uncertainty drive investors to sell off their stocks quickly. A correction, on the other hand, is milder. It's typically a decline of 10% or more from a recent peak, usually lasting for weeks or months. It's considered a normal part of market cycles. Both can be triggered by various factors. Economic slowdowns, unexpected events like geopolitical tensions or natural disasters, even investor sentiment can play a role. When confidence is low, markets can react negatively. Understanding these triggers helps you anticipate and prepare for potential downturns. Remember, corrections and crashes are different. While corrections can be healthy for the market, crashes can be more damaging. Let's talk triggers. What causes these sudden market tumbles that can shake the global economy? Remember the 2008 financial crisis? That was a crash triggered by a housing bubble burst. The collapse of the housing market led to a domino effect, causing banks to fail and economies to shrink. The COVID-19 pandemic in 2020? Another crash, fueled by economic shutdowns. Businesses closed, unemployment soared, and uncertainty gripped the world, leading to a sharp decline in market confidence. Geopolitical events like wars or trade disputes can also rock the markets. Tensions between nations can disrupt trade routes, affect commodity prices, and create a ripple effect across global markets. Sometimes it's simply irrational exuberance followed by fear that drives the swings. When investors get overly optimistic, prices can soar. But when fear sets in, panic selling can cause sharp declines. The key takeaway? Markets are complex, influenced by a myriad of factors. Economic indicators, investor sentiment, and global events all play a role in the market's behavior. So stay informed about global events and economic indicators in order to make more informed decisions. So, how do you protect yourself during these turbulent times? The answer lies in risk management. Firstly, diversification is your best friend. Don't put all your eggs in one basket. Spread your investments across different asset classes, stocks, bonds, real estate, etc. This cushions your portfolio from shocks. Another crucial strategy, have a long-term perspective. Avoid timing the market. Thirdly, use stop-loss orders to limit potential losses by automatically selling a stock when it drops below a certain price. Fourthly, avoid overcommitting to any single stock or sector. Proper position sizing ensures that individual losses won't significantly impact the overall portfolio. Lastly, corrections often provide the chance to buy quality stocks at lower prices. Look for companies with low debt, high cash reserves and stable earnings, as well as reliable cash flow, coupled with solid long-term growth prospects. Defensive sectors like utilities, healthcare and consumer staples typically perform better during market downturns, so consider having some stocks in your portfolio. And note that trying to predict the exact bottom or top is a fool's errand. That's all for today. Until next time, take good care of your finances, navigators, and don't forget to subscribe and share if you found any value.